The Morgan Report with David Morgan.
David Morgan, themorganreport.com with the weekly perspective for the week ending 17 April 2021. Well, stock market is showing some interesting rotations. The utilities index is actually the strongest sector out of the 11 sectors in the S&P 500, which indicates that we're possibly looking for more defensive type of positions in the overall stock market. And it was followed by others that are more known to be defensive positions. So we'll have to wait and see. It could be an indicator that even the smart money is moving into safer sectors as the stock market keeps forging ahead. On the dollar index, the dollar is backed off. It was quite strong. It's backing off at the present time. Of course, all markets ebb and flow, but the dollar does not look as strong as it did a few weeks ago. The commodity sector is strong, so another indication that the stock market may be seeing its top here, and I almost dislike saying that because calling tops is difficult, and especially when you've got a full board printing press going on supporting the stock market, the plunge protection team, or the better known working group on financial markets that started after 1987. There's a lot of momentum and a lot of reasons from the establishment to keep the stock market moving higher. So there's that. That's the roundup on that. I want to move into a few other things. By the way, I'm on themorganreport.com/blog, and this is where we post most of the interviews that we do. The silver watch list is over here, and we got a couple ads over here on gold and silver stacking program, the LOAD project, which is digitized gold and silver. And this is for very sophisticated investors from monetary metals on earning interest on gold and silver physically. All right, I try to do this every quarter. This is from Bob Johnson by way of Gold Sheet Mail. It's goldsheetsmail@googlegroups.com, and you can get involved if you'd like to get this it shows you down here, the link, www.goldsheetslinks.com. Shout out to you, Bob. You've been doing this for years and very much appreciated by a lot of us. So let's just go through what happened. I'm going to call this the end of the quarter, even though we're past March or mid-April. This is a week behind. No, it's not. I'm sorry. It's yesterday. So anyway, as of April 16th, year to date. So aluminum's up 16%. Cobalt, 55%. Copper, 20%. Lead, up 3%. Nickel's about flat. Tin's up 37%. And zinc's up almost 5%. On the precious metals, for year to date, gold is off 6%. Palladium is up 13%. And platinum staying with palladium right now, up 12%. Silver is off 1.5%, we'll call it. And the gold-silver ratio has dropped. It's currently at 72. The HUI is off 2.5%. The XAU is up 3.4%, and the dollar is up slightly at almost 2%. Crude up 30%, heating oil 27%, natural gas almost 6%, and gasoline 44%. So that's a look at the first quarter. I'll call it a little bit late, a couple of weeks late, but that gives you an overall idea. So you can obviously see that the base metals, copper, lead, zinc, nickel, tin even, are doing really better than the precious metals, save the PGMs and platinum group metals, which are doing respectable returns. But even aluminum has outperformed palladium so far this year. Cobalt has, hit it out of the park. So something to bear in mind. It does indicate, however, that the commodity sector, as I started this update with, this perspective, is really doing pretty well, and a lot of people are not aware of it. Usually when the stock market is top, the commodity sector starts moving up. First up is from CNBC. Gold heads for best week in 4 months on subdued dollar. Yields gold prices at a 7-week high on Friday and was on track for the best week since mid-December, bolstered by a softer dollar and sharp pullback in U.S. Treasuries in the previous session. So all true. Looks like it could be a bottom. I did say to the paid Morgan Report members in the latest report, which was out the first Monday of the month, that with silver hitting 24 and moving to 25, 3 trading sessions later, now around 26, that possibly is the bottom. Time will tell. There's a lot of fighting back and forth, tug of war between the bulls and the bears right now. But nonetheless, also the mining shares had quite a strong move up here in the last trading session. A site that I'm not that familiar with, a good article, Confounded Interest by Anthony B. Sanders, reaffirming what I said at the very opening, that revival, gold and silver rallies as the U.S. dollar index declines, as I said. Talks about a double cross. You can see what he's talking about here with the gold index and the dollar index, and you see the cross. And it's a bit technical, there's not much to say about it, but certainly another indicator that probably the worst is behind us for gold investors and silver investors. Again, we will see. And this is an article I thought I'd bring to the fore for the Mises Institute. For a big fan, I'm an Austrian, at least mostly so, and a big fan of Lew Rockwell and all that goes on there. This is from the website, is the Fed propping up the U.S. government. And it's a great article. I really would suggest everybody on this weekly perspective take a look. There's several highlights here. Deficit financing and debt servicing issues play no role in our policy decisions and never will. My objective today is to reinforce this message. Might think about that. The Congress has provided roughly $5.8 trillion during the past year to deal with the pandemic and its effects on the economy. I mean, this is moving toward hyperinflation. I mean, this is an amount of money that is unfathomable by most people, and percentage-wise of what the debt was prior to that, almost $6 trillion, is significant. It was like 30% or something in just the last, few months doing for the pandemic situation, several months, I guess. So new territory, we know where it usually ends. Is the U.S. government going to be any different? We will find out. The trend is clearly in place, and I don't think anything can stop it. I think the inevitability of a currency crisis lies in the not too distant future. And I'll just have to read this last one. The Federal Reserve's holding U.S. government debt has risen around $7 trillion, with about $2.5 trillion of that total resulting from asset purchases aimed at smoothing the credit market function, providing monetary accommodation. Is there a narrative that the Fed's financing the U.S. government to keep rates low, to service debt, or maintain asset purchases? It's hardly baseless, and that one that has been reinforced through countless policy decisions and speeches. It's difficult to defend the apparent virtues of a Fed independent from Congress, given last year's various emergency lending facilities, the skyrocketing government debt, and increases in the Fed's balance sheet, with spending programs run by the Treasury. The line between the Fed and U.S. government has never been more blurred. Should concern exist that a lack of independence would lead to a central bank which uses the money printer to pursue an anti-capitalist agenda, such as giving stimulus checks to people funded by government debt below the market interest rates, it's safe to say this line was crossed long ago, and a line crossed when independence still remained intact. And it's hard to do an update or weekly perspective without getting on Zero Hedge. They do such multitude of fine things and always have some very interesting, thought-provoking articles. This one, 76% of the rise in stocks since the March low is the third largest jump in 100 years. What happens next? And that's my question as well. I've already talked about going into a more protective stance with utilities and the other defensive type of stocks relative to, let's say, the go-go stocks. You can see, what's happening on inflation. This is a chart with the V-shaped inflation to come, showing, this year, last year. It shows, from 1990, but you can see up ebbs and flows, back and forth, and then boom, straight up. Small business filings Workers is very hard to find. You hear that in the financial press. U.S. banks breaking higher, secular turn in rates and inflation. So lots to think about this weekend. Good article. It's always worthwhile going to Zero Hedge. And I think I'll end it here with John Rubino. Can't say enough good about John. At dollarcollapse.com, also a site you should probably put into your bookmarks and look at, what, daily, weekly, whatever. Certainly worth getting over here. Yet another ridiculous stock market bubble in 3 charts. Margin debt. Huge. I mean, the amount of margin debt is right up here in red. All-time high, February. Again, you can see it's gone straight up. Usually when people get over-leveraged, they get hammered. The old adage that bulls make money and bears make money and pigs get slaughtered. Usually when you're using a lot of margin, using that leverage, you're starting to get greedy. That's usually been borne out before. It's where we're at. I do think we're probably close to top, but I've missed it before. Time will tell. Now during the spikes of margin debt, the investors who swept up in the euphoria of easy money frequently responded to criticism with a variation of corporate earnings are about to soar, which will make everything okay. Plus, we know you're complaining because you missed the train and you're jealous. And then you see the earnings, and you can see that they're basically trending down. And stocks are supposed to trade on earnings. I mean, when you own part of a company, the thing about this system that's so interesting is, if you want to be in business, you can. You can be in Amazon. You can be a shareholder of Amazon. You are in the Amazon business. You might not own a lot of it, but that is your business. You are a shareholder of that business. Anyway, the point being, why do you have any business? To profit. And that means that you're supposed to see stock valuations based on profit. Now, of course, you can have a bad quarter or even a bad, 6 months, a year even, but, it's supposed to reflect what you earn in your business. And the earnings on aggregate for the S&P 500 is off. So you shouldn't be seeing higher stock prices. I want to end here. This is a website that we've had up for a little while. I haven't given it any publicity at all. It's called the Morgan Millennial Minute. And this is obviously aimed at millennials. We are going to put more information up here. Obviously, the stuff I do, we're posting, but we are trying to get more and more bloggers and interviews with those that are leading the millennial space in the media, alternative or otherwise. So if you're interested, I'll give you a contact point. If you're interested in having us host your blog or doing an interview, or you have some commentary or you have some ideas, we are open to that. So if you're interested in getting involved or giving us some input, we have a Twitter account that's just been set up. It is a long address, but once you get there, you can contact us, do a private message, and get a hold of Alexander, who's pretty much in charge of the website, and let us know if you want to be interviewed, if you've got ideas, you've got blogs that we should link to, anything along those lines. And I should point out, to find it on Twitter, it is at Minute Morgan. Again, that's at Minute Morgan. Again, you can direct message or private message Alexander, and he'll be happy to get back with you and hopefully provide another forum if you are talking about the millennials and money. Primarily, it can be anything on the millennial thing, but we focus primarily on the financial conundrum facing all of us, and especially the millennials. So that's going to do it for this week's Weekly Perspective. I'll be back with you next week. It's David Morgan signing out. TheMorganReport.com.